So about the premises, like how I indicated, premises, office premises is a fixed asset, right? It will be classified as an expense if you don't own it and you are paying rent. In such a circumstance, it will not be captured in your financial statement as premises. It will be written as rent of office premises. Okay, so the substance will be the rent you are paying, and rent is an expense. I don't know if it makes sense to you now, Prof. Amanda. Right. Example, if it's a land, we know land is a fixed asset. But if you are renting the land, then you'll be capturing that in your books as rent and not building. Okay, so you'll be capturing as rent of building or rental of building. Okay, so the substance will be the rent you are paying, which is an expense, and not the asset as if you own it. Okay, so if you see premises in your trial balance, that's a fixed asset. But if you see rent on premises, then you see the dynamics change or the context change. The substance is rent. You are renting the premises, so it is not yours. You don't own it. Remember, assets are resources owned and controlled by the business. So if you are renting the building, you don't own it. So it doesn't qualify for an asset. If you are renting it, then it's the rent expense you acknowledge. So Prof. Amanda, that is a bit about the premises being expense or asset. Is it okay now? As in, do you understand now?
Yes, please.
Okay. So I'm sure probably the book was trying to put it in the context where you own the premises, then it's an asset. But if you are renting it, it's an expense. And so if you are renting, it's the rental that becomes the substance of the whole issue, right? And if you own it, you represent it in your financial statement as your fixed asset. Okay.
Where they are reacting to people trying to censor.
Please, can we move on? So we are done with all. If there are further questions, please feel free to ask me. I love it when you ask lots of questions. Maybe you've read something somewhere, or you heard something and you are a bit confused about it. Please share so that we discuss. Okay, I think my professors are okay. So we move on to the balance sheet. The balance sheet. Okay. I think last time I gave you a hint. Yes, Prof. I say.
Please, I sent you a message, I think on Monday, that there was this question on trading, yes, and in the terror series.
Yes.
377 were like well noted.
Yes.
And
So this is what I will expect from my professors. After dealing with the balance sheet, I think we'll pick that question and then solve or look at the requirements in the. I think you'll be preparing the trading profit and loss. I don't know if the balance sheet was added. Even if it was not added, we will prepare the balance sheet. Okay, so for now, let's go through the balance sheet and then we'll pick that question from the terror series and solve. Okay. Thank you for that. Or better still, maybe I would even put it on the page so that professors can try it and then we'll solve it together in class. That would be nice. Okay, so let's go to the balance sheet. Now, the balance sheet is the last financial statement prepared for a sole proprietor. Basically, the balance sheet tells the users of accounting information, the asset, capital, and liabilities of the business. Okay, so if you are asked to prepare a balance sheet, what they are simply requiring you to do is to present the assets, the liabilities, and the capital of the business. That's all that is expected of you. However, you would have to put it in a certain format to make its presentation more appealing and more acceptable. Okay, but the concept is that you are showing assets, liabilities, and capital. So it will be very important for us to appreciate what our assets are, what our liabilities are, and what the capital is. I think there's no doubt about the capital. So for the assets, you remember we have the fixed assets and we have the current assets. And for the liabilities too, we have the current liabilities and the long-term liabilities. So you have to appreciate that. So mainly this is the format for the balance sheet, right? So the first thing you begin with is your fixed asset. But of course, it has a title, and the title is Balance Sheet as at. Okay, please don't make a mistake of adding for the balance sheet for the year ended. And the reason why it has assets is because the balance sheet shows you the balances on your asset, liabilities, and capital from the date you started business. So for example, if you started business in 1995, your balance sheet today in 2025 is telling you the balance on your fixed asset from that time, okay, as at now. But if we say for the year ended, it simply means that you are preparing that statement for just 12 months or a particular year. So that's the difference between for the year ended and asset. Asset is more or less like accumulation of balances from the first day you started business until the current day you are reporting. Okay. But for the year ended, listen, for the year ended, so it's only looking at a particular year, mainly 12 months. Okay. So after bringing in your title, you start with your fixed assets, your fixed asset. And I want to believe my professors also remember that we have tangible fixed assets and intangible fixed assets. So it's prescribed that you bring your tangible. The tangibles are those you can see, you can feel them, you can touch them. So the examples you have here: land and building, fixtures and fittings, motor vehicles, office premises, like we saw, furniture, plant and machines. I think the last time we took our time to look at them, and there's a recording on that, a very short one. So please, those of us who need to watch that video so that we get grasp on our fixed asset. Okay. So in this format, I only showed land and building, fixtures and fittings, motor vehicle, but I also have plant and machines or machinery. We have motor van. Okay, so if you don't see motor vehicle and you see motor van, it's the same, right? Furniture, office furniture is also a fixed asset, and then premises. Okay. Then the intangibles, the one you cannot see, you cannot feel them, you cannot touch them, includes goodwill. Okay, and goodwill is more or less like the factors that makes a business successful or popular with the general public or customers. Okay. So goodwill is an asset. Why is it an asset? Because it is something that helps the business to make profit. Example, MTN now has a goodwill because of their services, maybe the prices and quality of internet services they render. You might have an argument though, but in Ghana right now, if you ask of the best communication network, I think majority of people will say MTN. So MTN has that goodwill compared to other communication network organizations or business, right? Well, if I may ask, between MTN and Airtel Tigo, which is popular? I think we all agree MTN is popular. So that popularity is making them get more revenue, because the more people know you, the more they buy your goods, the more they patronize your services. That's why goodwill is considered as an asset, a fixed asset. Now, patent and copyright. So you all know that copyright is more or less like, you don't want people to copy your text. It's more about writing a book or something. So you get that right, and people cannot make copies of your book and sell without your knowledge. Okay, now that particular right is helping you get profit. How? Because if not for the copyright, people would have been making copies and selling and making money out of it without your knowledge. But because of the copyright protection you have, people will now have to see you before they can even sell your product. So in a way, when they see you, you'd also charge them something, and that adds to your profit or income. Okay, so copyright and patent right. Patent right is also more of, a right protection on an innovation or invention you have done. Copyright is more centered on maybe books, movies, and those things. Investment. I think we know investment, right? You can buy the shares of another company. You can do government bonds and treasury bills, etc. Okay, so these are your fixed assets. Now, in terms of the amount column, we provide three. The balance sheet has 3 amount columns. Now, if you pay attention to the fixed assets column, you will know that, or you will see that we have cost, and then DEP. This DEP is depreciation. Let me note that here. And what does it mean? Has any of you come across that word depreciation? And what does it mean, depreciation? Yes, let me hear from you. Prof. Ashley, you have an idea as to what this means? Depreciation. Anybody with an idea? Depreciation. Yes, Prof. Ashley.
Yes, as I know that depreciation refers to the reduction in the value of an item over a given period of time due to usage over a given period of time and wear and tear.
Okay, that is true. That is very true. The bit I'll add is that depreciation looks at the fall in value of fixed tangible assets. Okay, so I'm sure when you bought your school bag, it was looking so fresh, but currently the zip is even tearing off or wearing off or breaking off. Some parts are torn. So we can say your bag is depreciating. The value of your bag is reducing. It is losing its original value. If you buy a car today, tear rubber, the body is very sharp, very beautiful, but as time goes on, some parts will be rusting, some will be wearing and tearing off. Even as you use it, some parts will be wearing off, and that is depreciation. So in our balance sheet, we acknowledge that part of the asset that is being missing or lost, and we less it from the cost of the asset. And the cost of the asset is how much you got the asset ready to use. Okay. So normally you less that depreciation from the cost and you get NBV. NBV here means net book value. Net book value. So for example, if your school bag was 100 cedis, that would be the cost of your bag, right? And maybe currently you do an assessment, you measure and see that maybe you have lost, let's say 20 cedis. 20 cedis of the bag is lost to depreciation, wear and tear, etc. So the difference between the two gives you the net book value, the NBV. Okay. Now the question is, how do you get this depreciation? Yes, there are various methods used to calculate this depreciation, and we'll get to work on some of these things. So that's your fixed assets. That's the first thing you bring in your balance sheet. The second thing you bring in is your current asset. Of course, after bringing your fixed asset, you move on to your current asset. If there are questions, you draw my attention. Now, professors, your current assets are the following: your stock, your closing stock, which is sometimes referred to as inventory. So stock is the same as inventory. The second one is your debtors or receivables, the customers who are owing the business, your debtors. The next is bank. How much do you have in your bank account? It's a current asset. Prepaid expenses. I think last time we explained this thing. Okay, you pay for the expense, but you have not incurred it. Like the way you pay for electricity before you use it. Now we are using the prepaid meter. So you have to pay for the electricity before you come home, insert it to use it. That's why it's termed prepaid, prepaid. Okay. So when you pay for the expense, even before you incur it, that's a prepaid expense, and it's a current asset. Another example I could give you is when you go and rent a room. You pay the landlord for 1 year, but actually maybe you are even now in the first month, but you have actually paid for 12 months. So you have prepaid 11 months. Okay, and that 11 months amount is your own resource because you haven't used the room, right? So you can decide to go to the landlord and say, okay, the 11 months I haven't stayed in the room, I haven't used it, so I need my money. And most of the time you hear this word being used, advance. You pay an advance. So prepaid expense can also be referred to as paying the expense in advance. Okay. Then the next bit is accrued income. Professors, when you hear the word accrued, it means owing. It hasn't been paid. It's in arrears. It's outstanding. It's due. It's due to be paid, right? So accrued income means income that is in arrears, income that the business has not received yet. Why is it an asset? Because, for example, if Prof. Aseye is a business and Prof. Aseye is supposed to receive some income from, let's say, GCB Bank, but GCB Bank hasn't paid it, so that income is in arrears, it has accrued. Prof. Aseye can boldly say that, oh, this money with GCB is my money, it's my resource, and they will definitely pay, right? So that's why it forms part of your current asset. And then the last bit is your cash, as in the fiscal cash you have in your pocket or in the business office or safe. Okay, please, any question, professors? So you list these current assets. Okay, you get the total. And the next thing is to bring in your current liability. So please, let's follow the format very well. You start with your fixed assets, okay, followed by your current assets. Then you now bring in your current liabilities. But watch out something here. We bring in the current liabilities because we want to less it from the current assets. So we normally less the current liabilities from the current assets. Why do we do that? We do that because we want to determine something called working capital. So professors, pay attention. Your fixed assets will be there waiting for you to come and compare your current assets with your current liabilities. And I just said that the result of that is called working capital. Okay. So it's the working capital that is added to the fixed asset. So you bring your current asset, you less your current liabilities, and whatever you get becomes the working capital. And this is highly examinable, so note it. You can be asked to explain working capital, or in objective tests, the difference between current asset and current liabilities is referred to as, and you should get that mark, working capital. Okay. So you see, after bringing your fixed asset, you pick your current assets, you less the current liabilities. Now the current liabilities are also as follows. The first one is your creditors, or sometimes referred to as payables. Okay. Payables because you pay them. Then the next one is bank overdraft. Bank overdraft is when you have a current account with the bank and they allow you to take more than what you have in your account. So let's say you have 100 cedis and the bank allows you to take 150. So the 50 becomes a bank overdraft. It's a form of a loan, okay, but it's very short. Immediately money comes into your bank account, it's deducted. And most of the public sector workers use this to get some funding when the salary is delaying. So they take the bank overdraft. When their salary comes, it is deducted. You pay a little interest on it, right? Great. After the bank overdraft, the next one is expense accrued. And if you appreciate, expense accrued is the opposite of prepaid expense, okay? So prepaid expense is a current asset. Accrued expense, and accrued I said means owing. You are owing the expense. That one is a liability. Okay. So the examples we gave for prepaid expense, this time maybe instead of paying the landlord for 12 months, you don't pay, but you have used the room. Then your rent has not been paid. So it's a rent accrued or rent owings or rent outstanding. Please watch out for the words I'm mentioning. Accrued, outstanding, unpaid, arrears, due. They mean the same thing. Okay. Then the final one is income prepaid. So income prepaid is also the opposite of income accrued. And I use Prof. Aseye to explain the income accrued, that she is supposed to receive some money from the bank. Maybe she made an investment and she's supposed to receive an income from that investment or interest from that investment, but the bank has not paid it. In this case, the bank has paid it even before the time. So Professor A would have received the income even before it's due her. So let's say the bank is supposed to pay Professor A 1,000 cedis interest every year. We are in 2025. If the bank has paid for 2026, which means Professor A has received the interest for 2026, the question is, are we in 2026? No. So Professor A has received that income in advance, which is also the same as income prepaid. So you have received it in advance, or the person has prepaid the income to you. The money is not yours because you are not yet in 2026. You haven't even finished 2026, and you have been paid, the income from 2026. So that is a liability. Right now, as I'm seated here, we are in January. If the government pays me my February salary, February 2025 salary, that money is not mine. It's a liability, right? So if I receive my salary in advance, if the government prepays my income Salary to me is a liability to me. Okay. So you bring in these items, like I indicated here, you get the total, and then you less it from the current asset to get the working capital. So when you get the working capital, it's added to the fixed asset. So please take note of what you see on my screen. You see that red working capital will be added to the total we had from the fixed asset. So you see, and those two figures will give you what we call net total assets. Net total assets. Net total assets. Net total assets. And that will be the first section of your balance sheet. The first section of your balance sheet. The second section of your balance sheet begins with financed by. So if these are your net assets, okay, how did you finance the asset? Okay, so the finance by will now look at the capital, which is how much the owner invested, as well as the long-term liabilities. So you see, yeah, Prof, I say you have a question. Let me hear you before I continue.
Someone,
Yes.
if you're saying that if we less the current liabilities from this one,
The current
if we less the current liabilities, is it from the summation of the current asset and the fixed asset?
Okay, so the point I'm making is you start with your fixed asset, right? You put the total down, and then you go and less
Yes.
your current liabilities from your current assets. That difference is called working capital. So it's the working capital that comes to add to the fixed asset for you to get the net totals. So if you see what I'm doing here, you see my fixed asset is down, right? And then I come here to list my current asset and I less my current liabilities here. Let me put in some figures. So let's assume our fixed asset is 1,000. That one will be, or 10,000, that will put aside. And let's say the current asset, we add the total because you have to list them one by one, your stock, your debtors, but you add all of them and let's say you get 500. Then you go to your current liabilities, maybe creditors, bank overdraft, and you add all of them, maybe you get 300. Then the difference between those two totals, right, is the working capital. In this case, will be 200. And it will be added to your fixed asset to get 10,200, which is representing your net total asset. Please, Prof, is that okay? Okay, great.
Yes.
Good. So under the finance by, you start with your capital. And the net profit you got from your profit and loss account, you add it. If the owner has made any drawings, you less it. Okay, so as you see here, you begin with your capital, you add net profit. If it's a loss, then you less it, right? Then you also less the drawings. So you remember the drawings we saw in that question. It will come to the balance sheet here to be deducted or less from the capital. Okay. And then finally, you add the long-term liability. For a sole proprietor, the long-term liability you'll be seeing is the loan, the bank loan. Then you add it to it. When you add, you arrive at a figure called capital employed. And your capital employed should always be equal to your net total asset. Because that ensures the principle of your balance sheet balancing. It has to balance. So your net total asset should be equal to your capital employed. Now, in simple terms, what the balance sheet means is that you are telling us you have a building, a machine, a vehicle, you also have stock, you have debtors, okay? you have some current liabilities. The question is, how did you finance the building? How did you get the stock? And the answer will be that, oh, I got it from the monies the owners invested. That's why under the finance by we have the capital, the resources coming from the owner. Okay, but we also ensure that if the owner has taken anything like drawings, we less it. And we also add the profit the business is making, because if you are doing business and you are making profit, you add it to your capital. If it's a loss, you less it from your capital. That's how come if you continue to make losses, your capital gets to zero and you have to shut down the business, because the money you invested in the business is gone because you have been making losses. Okay. And then the last bit is the long-term liability. You may have borrowed from a bank to help you buy those assets like the building and the stock, etc. Okay. So as for the second session, it looks very short. You bring your capital, you add net profit, you less drawings. The figure you get is your net capital, then you add the long-term liability, which is the bank loan. So that's your balance sheet. Again, professors, this is my caution or advice to you. Don't learn the whole thing at a time. Take them one by one. Okay. Because what is going to happen is that they will give you the trial balance like this, like the question we solved. Something like this. And they will ask you to prepare your balance sheet. Okay. So as an accounting student, if you're asked to prepare the balance sheet from this, first of all, you should know the items you are looking at for. You are looking at for your fixed asset, your current asset, your current liabilities, your capital, drawings, long-term liability. Okay. I think I'll pause here for questions, if there are questions. Prof. Amanda question, Prof. Aseye question, Prof. Sandra question, Prof. Frank, Prof. Ashley. Prof. Aseye, go ahead.
Mr. Moore, please. So after we found for the net total assets, right? Is that when our long-term liability will now come and less it? Or we are looking for the net total assets. So when we find it, like that's our endpoint or something.
Can you take your question again?
Like after we found for the net total assets, right? Is that when the long-term liability we will now list it from the net total asset, or what?
Okay, I think I get the picture or the point you are making. You see, the balance sheet can be presented in many formats. Okay, the format that you are saying is one that is used, I think in certain professions that is how they, or certain businesses, that's how they present their balance sheets. They bring their fixed asset, current asset, less the current liabilities to get working capital. After getting the net total assets, they less the long-term liabilities. But please, let's leave that for future endeavors or advanced learning. But for your level, bring your fixed asset, go and work out your working capital as in your current asset minus current liabilities, add it to the fixed asset, get the net total assets. After that, move to the finance by, where you present your capital and the long-term liability. The reason why we only less the current asset from the current liability is because, you see, look at her idea here. We want to compare current assets with current liability. Okay. So the long-term liability should not be part of that. The long-term liability is added to the capital because it is also a source, or it's a way we get money to finance a business. If we are looking at how you get money to finance a business, it's either the owner is investing, which is the capital, or we borrow long term. Okay, that's why some people, if they want to start a business, they go to the bank to borrow. So that long-term liability, in a way, is helping us to finance the business. That is why the balance sheet presentation we are looking at is looking at how did you finance the assets? And then we tell them that we finance the asset by the capital, which is money coming from the owner, and long-term borrowings or liabilities. Okay. So I'm sure probably you might have seen what you are saying in a book or something. For your level, stick to this presentation. Okay. If you get familiar with this, maybe I'll introduce you to the other forms of presentation. Various accountants, they manipulate the presentations. It's because of how they want to, report on certain things. But for your level, let's stick to this one. Thank you for the question. Any other question? Okay, so I think professors would finish up the class in the last session by solving or looking at the balance sheet of the question that we were looking at. Thank you very much. So let's meet in the last and final session.